Interest rates. Central banks around the world are continuing to raise interest rates to combat inflation. Interest rates have been seen in some countries at levels not last seen since the 2008 Great Financial Crisis. Rising interest rates can mean challenges for individuals, businesses, and governments. However, for those in the know, interest rates that rise can provide great opportunities for making money. So in this video, I'm going to share 5 ways you can make money in a rising interest rate environment. So interest rates are primarily influenced by central banks around the world. For example, the Federal Reserve in the United States, the Bank of Japan in Japan, the European Central Bank across Europe, the Bank of England in the UK, and so on and so forth. And the central bank's key job is ensuring price stability. That is ensuring that inflation doesn't get too high, or inflation doesn't get so low that it becomes negative, which is called deflation. So typically, most Western economies, central banks are trying to allow for a small amount of inflation in their economy, and most targets are around 2%. So when they're setting interest rates, they're setting them high enough that keeps inflation at a low enough level, and vice versa. And why interest rates are so important is when central banks set this core interest rate, which we call the base rate, it's what all other credit products are typically priced off. So whether you're going to buy a house and you need to raise a mortgage, the price of the mortgage, the interest rate that you're charged, will be priced off what the base rate has been set out by the central banks. Similarly, if you're going to buy a car and you need to get a car loan or an auto loan, again, the interest rate that you're charged is typically set off what the base rate is that the central bank has set it at. And other types of loans and credit products like business loans, like personal loans, etc. So this is why interest rates set by the central bank, i.e. the base rate, is so critical to any functioning normal economy. So now we know what interest rates are, it's really important to understand why they rise and fall. Now, if you haven't seen my video on inflation, you should check it out in the show notes below. Now, in an economy, if it is getting too hot, i.e. the economy is growing too quickly and inflation's running too high, then typically what central banks will do is raise interest rates to a certain level, make borrowing very expensive for people and businesses. It puts people and businesses off from borrowing, investing and spending, and therefore brings inflation down. Conversely, if an economy is sluggish and it's not performing very well, it needs a boost, and therefore inflation is very low, then what central banks may do is lower the interest rates to such a level that it induces people and businesses to borrow more money, because of course money's now cheap, and then go and spend and invest that money, thus causing stimulation in the economy and causing inflation to go up. So now we know what interest rates are and what causes them to rise and fall. I'm going to show you those 5 ways that you can make money in a rising interest rate environment. So here goes. So strategy number 1, invest in high yield savings accounts. Now, if you're fortunate enough to have some disposable income or some surplus savings, make sure that you're putting it in the best possible place to earn a high rate of interest. And your normal checking account or current account that you use to pay your bills may not be the best place to keep your surplus money. Now, what you want to do is speak to your local bank or the bank you're using, or shop around. The internet has great tools for doing this, and find out who may be paying you the best rate of interest. You want to make your money work hard for you, and any surplus cash should be paying you a higher, better rate of interest. Strategy number 2, bond investments. What are bonds? All bonds are IOUs. They are effectively pieces of paper that a government or a corporation, when they want to borrow money, will issue a bond which says, if you lend me X amount of money to finance my operations and spending, then at some point in the future, usually over a number of years, I'll pay you back that money Plus every year I'll provide you with some interest for lending me the money in the first place. So it's very much a loan. Now, the difference between a loan and a bond is that bonds are usually publicly traded, so there is a secondary market where you can buy and sell bonds between different participants as well. And so like a stock, it has a price, a trading price. Now, what's good about bonds is they tend to be liquid. If, as I said, there's a secondary market, you're able to sell in and out of them. If you have a pension or a superannuation scheme, the chances are a proportion of your pension will be invested in bonds. They typically seem to be safer investments. So consider bonds as a way of investing your surplus cash. Of course, when interest rates rise, bonds pay a higher rate of interest. Strategy number 3, real estate investment. Now, unless you're borrowing huge amounts of money, actually borrowing some money and paying some interest could be a very good way of getting into real estate. Real estate, as long as it's rental property, provides an income stream to you. And in high interest rates environments, what you'll find is because interest rates are high, that typically means inflation's running high. If inflation's running high, then the value of the property, the asset, will typically be increasing over time in a commensurate amount. And the second element of real estate is your rent that you're collecting. Rents are usually linked to wages and salaries that people can pay from, and wages and salaries are usually linked to inflation. Of course, if inflation's going up, then those people with jobs are usually looking for higher pay to compensate for their higher expenses. Higher wages, higher salary usually means higher rents for you. So it's a very good way of generating returns in a high interest rate environment. Strategy number 4, diversify your portfolio. So I've mentioned high interest savings accounts, I've mentioned bonds, I've mentioned real estate. You may look to invest in stocks, you may look to invest in commodities like gold, precious metals, etc. It's good to have investments in different asset classes because typically when some investments go up, others may go down, and you don't want to be overexposed to one particular asset class. And then finally, strategy number 5, investing in yourself. I've talked about this before. Investing in your own education, whether that's courses or reading books or listening to podcasts, etc., networking with people, all of these things contribute to your knowledge and make you smarter out there in better understanding your finances and the economy at large and how you might take advantage of that. Whether it's a high interest rate environment or a low interest rate environment, you're then equipped to know exactly what to do and how to maximize your wealth. So there you have it. 5 ways to make money in a high interest rate environment. Remember, investing in yourself, being out there, learning, being curious, talking to people, watching YouTube videos, listening to podcasts, whatever it may be, and however you consume your content and your materials. All of these things are going to help increase your chances of being successful, no matter the environment. So I wish you the very best, and I'll see you on the next video.